So we were doing problem number 10. In problem number 10, first time we are going to apply the Gordon's model. So here we have written cost of capital 10%, earnings per share 10 rupees, internal rate of return 15%, 10%, 8%. Then we are given retention ratios. Retention ratio is opposite of dividend payment ratio. If the payment is 40%, retention will be 60%. If the payment is 60%, retention will be 40%. That is opposite of payment ratio. So according to Gordon's market, the market price per share is P is equal to E into 1 minus B divided by KE minus BR. So these are the values. Now in our problem, we are given three internal rate of return, 15%, 10%, 8%. And we are given three cases when retention ratio is 60%, 40%, 10%. So in one table itself, we have calculated. We have applied all the values and we have simplified. We got 400, 100, 76.92, 150, 100, 88.24, 105.88, 100 and 97.83. So this is the problem number 10. Now we come to problem number 11. Now see the problem number 11. The following information is available in respect of a growing firm for determining its optimum dividend policy. Rate of return on investment are 16%. Cost of capital KE 10%, EPS 30 rupees. Calculate the value of the share according to Gordon's model if the payout ratio is given 50%, 60% and 100%. So first of all, problem number 11. Earnings per share. How much is the EPS given? 30 rupees. Then R is equal to 16%, 0.16. Then KE, cost of capital, is given as 10%, 0.10. Now, according to Gordon's model, market price per share P is equal to E into 1 minus B divided by KE minus BR, right? Now case 1. When the payout ratio is 50%, it is given in the problem. Calculate the value of the share of the firm according to Gordon's model if the payout ratio is 50%. Remember one point, in calculating Gordon's model, we don't require payout ratio. We want retention ratio. So here if payout ratio is 50%, therefore retention ratio will be 50%. That is B is equal to 0.5. When 50% are paid, so 50% are retained. So B will be taken 0.5. Now we substitute the value P is equal to E. How much is the earning? 30. 1 minus B, 1 minus 0.5. KE 0.10 minus BR. B is 0.5 into R is 0.16. We'll get the value. Now we'll come to case 2. If the payout ratio is 60%, therefore retention ratio will be 40%. If you take payout ratio as 60%, retention ratio will be 40%. So B is equal to 0.4, right? So P is equal to 30 into 1 minus 0.4 divided by KE 0.10 BR. That's it. Last one, case 3. If the payout ratio is 100%, If the payout ratio is 100%, therefore retention ratio will be 0%. B is equal to 0. When 100% are paid, retention will be 0. So B is equal to 0. P is equal to 30 into 1 minus 0 divided by 0.10 minus 0 into 0.16. That's it. We have substituted all the values in the formula to find out the market price per share. First case, it is 750. Second case, it is 500. And third case, it is rupees 300. That's it. Make your calculations and see the answer. You will get the answer 750 in the first case. When the payout ratio is 50%, market price per share is 750. When the payout ratio is 60%, market price per share is 500. When the payout ratio is 100%, then market price per share is 300. This is the problem number 11. Now, see the problem number 12. Problem number 12. The following information is available in respect of a growing firm for determining its optimum dividend payout ratio. Actually, this problem is exactly similar to the previous one. Rate of return on investment R is equal to 15%. Cost of capital KE 10%, EPS 20 rupees. Exactly same what we have done in the 11th problem. Only figures are changed. Calculate the value of the share according to Gordon's model if the payout ratio is 40%. When payout is 40, retention is 60. So B is equal to 0.6. Second, when the payout ratio is 60%. When payout is 60%, retention ratio will be 40%. So B is equal to 0.4. And when payout ratio is 90%, retention ratio will be 10%. So B is equal to 0.1. Same, exactly same. Only figures are different. So you can do this 12th problem as your practice homework problem. The answer for this 12th problem. Answer for this 12th problem is case A, B, C. I'm having the answer. I will write down the answer so that you can confirm it. 800. B is rupees 300. And C is rupees 211.76. These are the answers you will get if you solve the problem. This is problem number 12. Now 13th problem. Problem number 13 you see. Following information related to three companies A Limited, B Limited, C Limited. EPS 10 rupees for all the companies. Capitalization, rate of equity. Rate of equity means KE. So KE are 10% for all. IRR, internal rate of return, 15%, 10%, 8%. What is the market value of the share under Walter's model if the retention rate is 40% and 80%? The two cases are given. Then what is the market value of the share under Gordon's model if the retention rate is 40% and 60%? So separately we have to calculate for A Limited, B Limited and C Limited. So in tabular form we can easily make, first of all, first A bit, 12th, it is 13th problem. 13th problem will take, what is the market value of the share according to Walter? According to Walter, P is equal to D plus R by KE into E minus D divided by KE. This is the formula of Walter. A Limited, B Limited and C Limited. R is equal to 15%, 0.15. R is equal to 10%, 0.1. R is equal to 8%, 0.08. Now case 1. In the first, it is given what is the market value of the share under Walters model if the retention rate. Actually, for applying Walters model, we don't require retention ratio. We want payout ratio. ये रिटेंशन रेशो की जरूरत जो है गॉर्डन में पड़ती है। गॉर्डन के लिए रिटेंशन रेशो चाहिए और वॉल्टर के लिए हमको पे आउट रेशो चाहिए। सो हियर इट इज गिवन रिटेंशन रेशो 40%। Therefore, DP ratio 60%. तो D is equal to 60% of EPS. So D is equal to 60% of. How much is the earnings per share given? 10 rupees. First line it is given earnings per share 10 rupees. So 60% of 10 rupees is 6 rupees. Similarly, case 2. When the retention ratio is case 2 retention ratio 80%. Therefore, DP ratio is equal to 20%. D is equal to 20% of 10. D is equal to 2. Only 2 cases. In the problem it is given only 2 cases. What is the market value of the share under Walters model if the retention rate are 40 and 80? When retention ratio is 40, DP ratio 60. So D is equal to 60% of EPS, 6 rupees. When the retention ratio is 80%, DP ratio is 20%. So D is equal to 20% of 10, 2 rupees. Now we have to substitute P is equal to D. The D is 6 rupees plus R by KE. R is 0.15. KE is 0.10. E minus D, 10 minus 6 divided by 0.10. Similarly, P is equal to 6 plus 0.10 divided by 0.10, 8 minus 6 divided by 0.10. P is equal to 6.08 divided by 0.10, 10 minus 6. Here dividend is 2 rupees. 2 plus 0.15 divided by 0.10. 10 minus 2 divided by 0.10. That's it. So it comes to 120. It is 100. Here 92. Similarly, here it is 140, 100, 84. That's it. So these calculations we have made for Walters. Now B question is, according to Gordon, according to Gordon's model, P is equal to E into 1 minus B divided by KE minus BR. case 1. Now see the problem case 1. What is the market value of the share under Gordon's model if the retention rate is 40%? Here directly retention rate is given and we need retention ratio. Retention rate is 40%. B is equal to 0.4. Similarly, case 2. Retention rate is 60%. B is equal to 0.6. That's all. Now simply we substitute the values. P is equal to E. The earnings per share is here 10. Earnings per share. Earnings per share is 10 rupees given in the problem. 10 into 1 minus 0.4 divided by KE is 0.10 minus B into R. B 0.4 into R is 0.15. Similarly, P is equal to 10 into 1 minus 0.4 divided by 0.10 minus 0.4 into 0.1. Last one, P is equal to 10 into 1 minus 0.4 divided by 0.10, 0.4 into 0.08. Same calculations here. P is equal to 10 into 1 minus 0.6. B is 0.6. 0.10 minus 0.6 into 0.15. Simply we are substituting. P is equal to 10 into 1 minus 0.6 divided by 0.10 minus 0.6 into 0.1. Lastly, P is equal to 10 into 0.6 divided by 0.10 minus 0.6 into 0.08. That's it. Now if you simplify, you will get the values 150, 100, 88.24, 400, 100, 76.92. Check the calculations. Right. So in this problem, we have applied both the techniques, Walter as well as Gordon. Both the techniques we have applied in this problem to calculate the value of the share. See the next problem. Problem number 14. Now problem number 14 is a different problem. It's a Modigliani and Miller problem. The problem is on Modigliani and Miller. First time we are going to apply. So far we have applied Walter's formula and Gordon's formula. Now see the 14th problem. ABC Limited has a capital of rupees 10 lakhs in equity share of rupees 100 each. The total capital employed is 10 lakh. The face value of each share is 100. So 10 lakh divided by 100 you will get 10,000. The company is having 10,000 shares of rupees 100 each. That is the point. Shares are currently quoted at par. Par means face value. मार्केट में इस वक्त शेयर जो बिक रहा है, ट्रेडिंग हो रही है, वो 100 रुपीस मार्केट प्राइस है. The company proposes declaration of dividend of rupees 10 per share at the end of the current financial year. Company is planning to give 10 rupees dividend per share at the end of the year. The capitalization rate of the risk class to which the company belongs is 12%. KE, cost of capital. What will be the market price of the share at the end of the year if a dividend is not declared and a dividend is declared? So in this problem we want to find out what would be the value of the share at the end of the year if dividend is not declared and dividend is declared. Two separate cases. Assuming that the company pays the dividend and net profit and has net profit of rupees 5 lakh and makes new investment of 10 lakh during the period, how many shares must be issued? Use the model. stands for Modigliani and Miller model. So two different questions. The first question is, we have to find out what would be the market price per share at the end of the year if dividend is not declared and if dividend is declared. पहला क्वेश्चन. दूसरा क्वेश्चन ये है कि कंपनी के पास 5 लाख रुपीस प्रॉफिट है और कंपनी उसमें से डिविडेंड पे कर देगा. पे करने के बाद अब कंपनी को 10 लाख रुपीस इन्वेस्टमेंट के लिए चाहिए. तो हाउ मेनी न्यू शेयर्स मस्ट बी इश्यूड टू रेज द रिक्वायर्ड अमाउंट? दैट इज द सेकंड क्वेश्चन. लेकिन वो बाद में, पहले फर्स्ट ऑफ ऑल वी कैलकुलेट what is the market value, what is the value of the share at the end of the year if dividend is declared and if dividend is not declared. So this is the problem number 14. 14th problem. According to model, Modigliani and Miller model, the market price per share at the end of the year will be calculated as follows. PO is equal to D1 plus P1 divided by 1 plus KE, where PO is equal to current market price rupees 100. Current market price per share is rupees 100. D1 is equal to dividend to be paid at the end of the year, rupees 10. P1 is equal to the market price at the end of the year. This we have to find out. And KE is equal to cost of capital or capitalization rate. That is given in the problem as 12%. This is the formula to calculate the value of the share at the end of the year according to model. Now see here. Two cases it is asking you. Case 1, if the dividend is not declared. Case 1, if the dividend is not declared, that is D1 is equal to 0. D1 is equal to 0. If dividend is not declared, what is the value of the share at the end of the year? So we can substitute the values. PO is equal to D1 plus P1 divided by 1 plus K. PO stands for current market price. At present, what is the market price? Given in the problem. Problem में दे दिया कि currently the shares are quoted at par in the market. Par value means face value. 100 रुपए का शेयर 100 रुपए में मार्केट में बिक रहा. D1 0. It is asking you to calculate the value of the share at the end of the year when no dividend is declared. Plus P1 we have to find out. Price of share at the end of the year we have to find out. 1 plus KE, cost of capital is 12%, 0.12. So 100 is equal to P1 divided by 1.12. 1 plus 0.12 is 1.12. 0 plus P1 is P1. Now if we make a cross multiplication, P1 is equal to 100 into 1.12. So P1 is equal to 112. Therefore, market price per share at the end of the year, if dividend is not declared, is equal to rupees 112. First answer we have completed. The first answer, if dividend is not declared, what is the market price at the end of the year? End of the year का मतलब P1. ये पूरे इक्वेशन में P1 मालूम करना है. PO करंट मार्केट प्राइस दे दिया. D1 0. P1 we have to find out. K 0.12. Simplify कर दो 112. Now we'll come to case 2. If dividend is declared, that is D1 is equal to rupees 10. Here it is given dividend to be paid at the end of the year rupees 10. Now we substitute PO is equal to D1 plus P1 divided by 1 plus K. So 100 is equal to 10 plus P1 divided by 1 plus 0.12. Now we can write like this. 100 is equal to 10 plus P1 divided by 1 plus 0.12 is 1.12. Now if we make a cross multiplication, 10 plus P1 is equal to 1.100. 10 plus P1 is equal to 112. 100 into 1.12 is 112. So P1 is equal to 112 minus 10. P1 is equal to 102. Therefore, market price per share, if dividend is paid, is equal to rupees 102. That's first bit we have completed. The first bit we have completed. What is the market price of share at the end of the year if dividend is not declared and if dividend is declared, both. Now secondly we will calculate the number of shares. Assuming that the company pays the dividend and have net profit of rupees 5 lakh and make new investment of 10 lakh during the period, how many shares must be issued? Yes, second part. So profit available is equal to 5 lakh. Profit available is equal to 5 lakh less dividend paid. So totally 10,000 shares into rupees 10 is equal to 1 lakh. Remaining amount is 4 lakh. Remaining profit